On Friday, we discussed the review of the profit and losses from the strategies we discussed in a previous presentation last week, Are You Playing the Rate Hike? We showed how the married put or collar spread would have turned out, deep in the money covered call, deep out of the money naked put, straddles, strangles, iron condors, and some other positions as well after the rate hike announcement was released. Near the end of Friday's session, Victor had asked, would you buy strangles and straddles on the Ultra ETFs, the 2X and 3X, to take advantage of more volatility? Or are they too expensive? Would they yield better or worse profits by percentage? What is a long bought strangle or straddle position? Well, a long strangle is where we'll buy an out-of-the-money call above the current stock price, and an out-of-the-money put below the current stock price on the same security with the same expiration. Because they're out of the money, we have a relatively low-cost position, and we're anticipating a sudden or volatile market move in one direction or the other based on a known event or just market uncertainty. A long straddle is similar, but we'll buy the at-the-money call and put closest to the current stock price, with again the same expiration, which will result in a higher cost, but it usually gives slightly better break-evens, meaning less movement is needed to the upside or to the downside in order to realize a profit. On Friday, we did a quick comparison. We looked at a long straddle and a long strangle on QQQ. We used the historical tools and PowerOptions and took the values from the closing prices on September 20th, Tuesday, before the FOMC meeting. We then compared it to TQQQ, which was the Ultra Pro ETF 3 times, bullish 3 times ETF, mirroring QQQ. It did not compare against SQQ, the inverse 3X, QID, the inverse 2X, or QLD, the bullish or pro 2X ETF. Now, I was going to post that discussion as always, but I noticed a subtle flaw in the analysis. We wanted to go a little bit deeper. The initial comparison on Friday using the historical chains. On September 20th, QQQ closed at 288.73. We looked at a long straddle the 10th of October, 289 call and 289 put. Total cost per contract was $17.02. The strangle, we bought the out-of-the-money 300 call, had a delta of around 0.33, 0.328 for $3.90, and looked at the out-of-the-money 280 put with a delta of 0.32, or a price of 4.48. So the total cost was $8.38, or $838 to buy one contract of each. Comparatively, TQQQ, the bull 3 times QQQ ETF, closed at 24.59. We looked at the 7th of October, 24.50 call and put with a total cost of $4.28. The strangle, about $1.50 out of the money, the 07 October 26 call, which had a delta of 0.435 and a cost of $1.49, and the 07 October 23 put with a delta of 0.331 or $1.46. Total cost in the TQQQ long strangle was $2.95 for one contract. We entered those into the portfolio and just took a quick look at the liquidation values. What we saw on Friday at around 5:25 p.m. Eastern Time is QQQ closed at 275.15, down $13.22 or 4.6%. The straddle position for QQQ that cost $17.02 could be liquidated for a total value of $18.16. So we had a profit of $114 or 6.7% of the $17.02 invested in the position. The TQQQ straddle did not look so good. TQQQ was closed at 21.31, down 3.28 from the price on September 20th, or 13.4%. It seems about right. 3 times ETF, Bullish ETF declined 13.4% when the standard moved 4.6%. It's about a 3 times percentage movement. However, the TQQQ straddle was essentially at break even. On the strangle, the QQQ strangle had a cost basis of $838, could have been liquidated for a value of $1,059 or a profit of $221 or 26.4%. The TQQQ 3X strangle was again just at break even, small loss of $1 or minus 0.3%. But this was flawed. The first flaw is obvious. We used the 10th of October, which was the Monday expiration for QQQ. Ironically, the prices were right, but we accidentally entered in the portfolio with the 10th of October expiration, meaning there might have been more time value reflected in that position that wasn't accurate. TQQQ only has weeklies. It doesn't have the Monday, Wednesday, and Friday expiration, so we use 7th of October. The 3-day difference might have mattered in the sense of extra time decay for the TQQQ positions versus what we were pointing to the QQQs. The second flaw was subtle. The call delta on the TQQ strangle, 7th of October 26, was 0.435. That's a higher percentage than the average 0.32 or 0.324 deltas for the QQQ strangle position. And the third flaw is that although the straddles were at the money as close as it could be, the QQQ strangle options were 3.9% out of the money and 3% out of the money for the put, respectively. The TQQQ strangle was 5.7% out of the money for the call and 6.5% out of the money in the put. I don't think we were really comparing apples to apples in that case. So maybe instead of delta, we're just going to focus on the percent range out of the money for the strangles for more of a fair comparison. Our new comparison, we're going to use 20th September, closing prices, the same open date as we started with, pre-rate hike announcement. We're going to look at the 7th October expiration for straddles for QQQ, TQQQ, the inverse 3X SQQQ, the 2 times inverse QIL, and 2 times pro QLD. We're going to be as at the money as possible. We already know how TQQQ turned out, looking at Friday's values on September 23rd. Now we're going to look at strangles also for QQQ, TQQQ, SQQQ, the 3X inverse, QIL, the 2X inverse, and QLD, the 2X pro. We're going to go as close to just 3% out of the money for the call and the put option in these strangles, and we're not going to use the delta. What changed in the first example? Again, we know QQQ closed on September 20th at 288.73. The straddle remained the same, and we had the correct prices. We just had to point to the correct expiration, 7th of October. The new strangle, going 3% out of the money, which was fairly easy with $1.50 strike differences. On 20th September, we might have bought the 7th of October, 297.5 call for 482. This was 3% out of the money, a delta of 0.345. Then we'd buy the 7th of October 280 put at 484, 3% out of the money, and we have a minus 0.31 delta. We're starting off relatively delta opposed in these positions. Now the total debit was 966, but in straddles and strangles we sometimes refer to the percent debit. What is the cost of the strangle against the underlying? And for this QQQ strangle, it was only 3.3% cost basis to the underlying price. TQQQ, September 20th close, 24.59. The straddle remained the same. We got that one right. The new strangle, by the 7th of October, 25.50 call at $1.70. This was 3.7% out of the money, as close to 3% we could get with the strike prices available, but it did have a 0.473 delta. Then we'd also buy the 07 October 24 put at 187. 2.4% out of the money. We didn't want to go to the next strike, which was actually 4.1% out of the money. And this gave us a minus 0.409 delta. The percent debit here was $3.57 total for the Strangle, with the underlying at 24.59. So our percent debit was 14.5%. A week later, profit and losses of around 2:30 p.m. Eastern Time on Tuesday, September 27th. QQQ is at 272.49, down $16.24 from our 288.73, or down 5.6%. TQQQ is at 20.57. We're down 402, or 16.3%, which again makes sense. The standard dropped 5.6%. TQQQ, the 3X, would be down almost 3 times as much at 16.3. But again, we saw a similar thing. The QQQ Straddle, with that cost basis of 1702, had a liquidation value at that time of 1940, or profit of 238, or 14% against the investment. Whereas the 3X TQQQ, which cost 428, could be closed for 465, profit of $37, or only 8.5%. On the Strangle position, we see a profit of roughly $217, or 22.5% against the cost basis of $966 for the standard QQQ Strangle, and TQQQ, the 3 times bull, only at a profit of $52, or 14.4% against the cost basis of $357. Now, let's go into the inverse. The 3X inverse SQQQ positions with the same structure. Closing price on September 20th, the Tuesday, was $49.08. We would have bought the 7th of October 49 call on SQQQ for $445 and bought the at the money 07 October 49 put at $435. Total cost of $880, which is a percent debit of 17.9% against the underlying price of $49.08. Our Strangle position, the 07 October 51 call at $3.68 per contract, 3.9% out of the money, 0.475 delta. And then we would have looked at the 07 October 47.5 put at $350, 3.2% out of the money, negative 0.394 delta. Debit total of $7.18, but against the underlying of $49.08, this gives us a percent debit of 14.6%. How did these pan out? Well, in comparison, right around 3 p.m. Eastern Time, QQQ is still down about 4.8%. TQQQ is down about 14.2%, so not as much as we saw before, but still down. And SQQQ is up $7.65 to $56.73, or positive 15.6%. And as we see here, the new highest return is the inverse 3X SQQQ Straddle at a 14% profit. And at this time, the SQQQ Strangle actually had the highest percentage profit with a profit of $129, or 17.9% against the investment. The TQQQ Straddle, giving a little bit up, was just back to break even, and the QQQ Straddle and Strangle were still at a profit 4.2% and 7.1%. Now we have come this far, about 15 minutes in. Let's go ahead and compare the 2X Pro and inverse QQQ, looking at QLD and QID with the same structures. Now, a subtle issue here, we can only use the October 21st standard expiration. QLD and QID do not offer weekly options. We'll deal with that. Our September 20th QLD closed at 42.95. This is the 2X Bull or Pro ETF. It's going to decline as QQQ declines. The long straddle, 21st of October, 43 call and put, prices of 330 and 320 for a total cost of 650, or a percent debit of 15.1% against the underlying price of 42.95. Our strangle position, trying to get as close to 3% out of the money as possible, but with the strikes available, we didn't want to go too low and be only 2% out of the money. We did have to extend it, so we bought the 21st of October, 45 call at 228. This was 4.8% out of the money, a 0.44 delta. And we looked at the 41 puts of roughly $2 up and $2 down, and the 41 put had a cost of $235. It's 4.5% out of the money, delta of minus 0.363. Anyway, the total cost was $463, which gives us a percent debit of 10.8% against the underlying price. QID, the 2X inverse or short, closed at 23.60 on September 20th. Our straddle, the 21st of October, 24 call and 24 put. Total cost is $373, and that's a percent debit of 15.8% against the underlying price. The long strangle was difficult, but we did the best we could. The 21st of October, 25 call at 133. It's about 6% out of the money with a 0.43 delta. We didn't want to use the 24 because it was too close to at the money. And then we used the October 23 put at 145, which was 2.5% out of the money, or a minus 0.402 delta. Total cost was $278 for a percent debit of 11.8%. Let's take a look at the 5 at-the-money straddles, right at about 3:30 p.m. Eastern Time, September 27th, a week later. QQQ is still down 5%. TQQQ is down 14.8%. That's about our 3-to-1. SQQQ is up 16.5%, a little bit more than the standard 3 times move from the standard position. QLD, the 2X Pro, is down 10.1%, all right, pretty close to 2-to-1. QID was up $2.57, or 10.9%, a little bit more than 3 times the 5.1% QQQ was down. What are our winners right now? Well, the QQQ straddle still has about a 7.7% profit. But the QID, the 2X inverse, now is slightly higher at 7.9%. It's only a $30 profit. Remember, we're dealing with a lower cost basis here, $373 versus $1702 for QQQ. The big winner remains SQQQ straddle, the 3 times inverse or short. We have a profit of $160 or 18.1%. All 5 straddles are profitable, but the lowest profits are on the 3X Pro and the 2X Pro or bullish ETFs, QLD and TQQQ. How do our strangles pan out? Again, right around the same prices, 3:30 p.m. Eastern Time on September 27th. The highest return is at 20.1% for the SQQQ 3X inverse QQQ ETF. Profit of $144 or 20.1% on the investment. The second place goes to the inverse 2X ETF, the QID strangle position, a profit of $37 only, but that's 13.3%. The profit on the standard ETF, QQQ, even with the higher cost basis of $966, still $120 or 12.4%. Not too far behind the 2X inverse QID strangle percentage-wise. And the lowest percentages, the TQQQ 3 times bull with only a 7.8% return, and the QLD 2X Pro or bull ETF only at a profit of 5.3%. Now let's table that and just take a quick look organized by highest percentage return. The highest returns went to the 3x inverse QQQ ETF, SQQQ Strangle, cost of 718, 14.6% debit. The change in the underlying was 16.5%, and we saw a profit of 20.1%. The inverse 3x straddle position, profit of 160, 18.1% liquidation gain around 3:30 p.m. on September 20th, and the cost to debit was 17.9%. The 2x QID inverse strangle, the inverse QQQ, an 11.8% debit cost. The underlying moved 10.9%. We see a profit of only $37, but it's a 13.3% return. The QQQ Strangle, debit cost was only 3.3%. QQQ is down 5.1% a week later. We have a profit of 120, which is 12.4% of the investment of 966. And in fifth place, the QID Straddle, 2x inverse, was a 15.8% debit cost. We're making a $30 profit, but that's 7.9%. Now finally, the Strangle shows up for TQQQ, the 3x Pro. It was a 14.5% cost to debit. We saw a 14.8% decline in the position. Have a profit of $28 or 7.8%, pretty similar to the QID Straddle. And then the QQQ Straddle. Very expensive, highest cost, $17.02. But that was only 5.9% debit percentage against the underlying. QQQ moved down that 5.1%. We have a profit of $131 or 7.7%. And the last three positions are held by the bull 2x QQQ ETF, the QLD Strangle, and the QLD Straddle, and the TQQQ, the 3 times Pro or bull QQQ Straddle position, with profits of only 5.3%, 2.9%, and 1.9%. Were those the highest returns? Now, I cannot say every day intraday, but using the historical tools and power options, isolating most of the positions using the backtest tools, the Smart History Excel or the search by symbol, we can use the Analyze Position feature to see where the highest profits likely were. Our top 2 profit positions, the SQQ Straddle and SQQ Strangle. The Strangle on 9/27 at 3:30 was a profit of 20.1%. This is showing us the historical returns of that position since 9/20, and we see the peak really comes up on 9/26. Now that's based on closing prices, but I think intraday on 9/26 might have seen a slightly higher return. The straddle return for SQQQ on 9/27, around 3:30 p.m. Eastern Time, was 18.1%. The closing prices on September 26th was a 19.3% return, so it was slightly higher, and intraday it might have been higher than that. The next highest 2, the QID Strangle, the inverse 2x QQQ, showed a profit of 13.3% on 9/27, right before the market closed. Now, on September 26th, it was around 11.7%, but you see that was the peak of the return, so maybe intraday it went slightly higher than that. Hard to say, but again. And the QQQ Strangle showed a profit of 12.4% on 9/27, but we see the return at close of 9/26 was almost 15%, 14.92, so we might have got a better closing value intraday on September 26th. But looking at the different closing days, the comparable returns were similar. Whether we looked intraday on the 27th or on the 28th even, the close of day using the historical tools, most of the snapshots at any time gave almost the same order of profits from highest to lowest that we saw in the previous table. Using those historical tools, I'm going to say that September 26th so far might have been the best day to close those positions. We're getting closer to expiration for 7th of October. The markets are settling a little bit, and we are starting to lose time value. But what have we seen so far? Are there other things going on that we should be aware of? Did the 2x and 3x ETF had wider bid-ask spreads that inflated the midpoint closing prices of our analysis? Well, no. When I was looking at it intraday and looking at it at the closing prices on the historical chains, all options used for these samples from the 23rd on Friday, when we originally tried to do this but wanted to enhance it, the bid-ask spreads were reasonable. They were under 10 or 15% between the bid and the ask price, usually under 15 cents or 50 cents. Was there a major shift in implied volatility comparatively between the 2x and 3x ETFs versus the standard? Well, on 920 SQQ, average for the four options had an implied volatility of 1.0445, dropped down to 0.9708 on September 23rd, so we saw a change of 7.1% in IV. And on the 27th, it bounced back up very close to where it was initially at 1.0684. Now, although that was a 10% increase from 923 to 927, overall, the total change was only 2.3%. The same with TQQ. It dropped 8% from the 20th to the 23rd average implied volatility of all four options, came back up, and only a change of 2.3%. Interestingly enough, the 2x ETFs had more of a change in implied volatility, but it's still subtle. We went from 0.6703 on QID on September 20th to 0.6435 on the 23rd, a drop of around 4%. Then it recovered another 8%, just like the others did with market movements. It's back up to 0.6964, so it is a change of about 4% in that 7-day period. Not a lot, but it would have helped the position, not hurt it, when we looked at the closing prices and at 3:30 p.m. on 9/27. QLD is the same, a change down about 2.3% from the 20th to the 23rd, then back up to 0.6721 on the 27th. We only see a change of 4.4%. And QQQ, which surprisingly was in the top 4 returns with a strangle position and wasn't the bottom with a straddle position, only had a change over those 7 days of 0.44%. Didn't really give us a benefit, but it didn't really hurt us either. So we're not missing any wide flux and implied volatilities. SQQQ, with a change over time of only 2.3% over that 7-day period, still had the top 2 returns. And what can this lead us to as far as basic conclusions? The question was, would you buy Strangles or Straddles on the Ultra ETFs to take advantage of more volatility, or are they too expensive? Would they yield better or worse profits by a percentage? In this experiment, we have seen that that is not always the case. Did the Ultra 3x SQQQ and TQQQ Straddle and Strangle have the highest returns? SQQQ did. The 3x inverse or short ETF that was in the direction that the market moved after the announcement. TQQQ Straddles and Strangles, even though it's a 3x, were lower than just the standard ETF. Similarly, did the 2x QID and QLD have a better return than the standard? QID did. Again, the inverse short that was in the direction that the market moved after the announcement. QLD did not. It's the lowest straddle and strangle return in comparison. So we can say maybe that the 2x and 3x Ultra ETFs can give a higher return. But you need to pick the right direction comparatively against the standard underlying ETF. Because if I pick a bull 3x and the market falls, the bull 3x is not likely to outperform the standard ETF. But the inverse or short ETF would, as long as it's in that direction. Now, of course, a disclaimer. As you've heard me say before, one sample, many samples, or examples does not the market make. We may have to follow this up to see if TQQ, the 3x Pro or Bull ETF, and QLD, the 2x Bull or Pro ETF, outperformed SQQQ, QID and QQQ in an upward market trend. Be aware of the percent debit compared to the underlying of your position. The 3 times ETFs were around 18 to 14% to the underlying price. The 2Xs were 15 to 10%. And the standard was around 6% for the straddle to 3% for the strangle. Why is that important? Because that gives you a gauge at least of a movement you would expect to see in order to start seeing profits on these positions. Large movements are needed for successful long straddles or strangles. We saw several profits on all of these positions with the market movement, but we're not seeing 50% returns, 200% returns, or 300% returns. We're just looking at the positions that we wanted to analyze for the experiment. So larger movements are needed if you're expecting 40, 50, 60% profits on these positions, or a longer time frame. We'll talk about that later. With straddles or strangles, buying straddles or strangles, beware of Death Valley, that U-shaped groove where you can lose money, or what we sometimes call no man's land, the V-shaped loss area in the straddle position. Large percent losses of what you paid can be seen. That's the lie of leverage. If the expected move does not materialize, or if the market settles and the implied volatility declines. Straddles and strangles, buying or selling, do involve risk and may not be suitable for all investors. Make sure you analyze all the pros and cons before jumping into either, especially on a 2X or 3X pro or inverse ETF.